You're watching Deal Flow, the show that tracks merger and acquisition activity in Africa and beyond. It's the world of investment banking, corporate takeovers and private equity deals on your screen. I'm Erica van der Merwe. Tonight's discussion considers the issue of pricing. Is there a price expectations gap between buyers and sellers in the market, and how is this affecting corporate action? Tonight's guest for this, Carel Vosloo from RMB. Before we start the discussion, we look at some of the deals of the week. Pharmaceutical group ASPEN is in talks to buy thrombosis drug brands and a French factory from GLAXOSMITHKLINE in a $1 billion deal that would widen its portfolio of medicines. Global brewer SAB Miller has entered into an agreement for the licensing of Kopparberg cider products in certain markets. Dubai-headquartered private equity group ABRAAJ will acquire African dairy firm Fan Milk. This allows it to tap into fast-growing consumer spending in 6 West African countries. The UK government is ready to start selling its shares in Lloyds Bank and will examine whether to break up Royal Bank of Scotland. That's after Finance Minister George Osborne acknowledged the reprivatisation of RBS remains a long way off. Billionaire investor Carl Icahn promised Dell shareholders that the company would buy back up to $16 billion of stock if they join his campaign to stop the computer maker from going private. A New York City real estate company offered to buy the Empire State Building for $2 billion, significantly below the skyscraper's appraisal value, and about 3 weeks after investors in the iconic building approved a plan to take the tower public. Tonight we're looking at the state of the M&A environment in South Africa. Now, while sentiment generally is on the soft side, typically an inhibitor to deal flow, there's also the matter of lofty stock market valuations. Is there a huge divide between buyers and sellers' pricing expectations? My guest is Carel Vosloo, co-head of the Corporate Finance Division at Rand Merchant Bank. Welcome, Carel. Really good to have you here.
Thank you, Erica.
So I've started that just referring to the price expectations gap, because you hear this referred to a great deal. We're seeing the listed market flowing, moving ahead, owing largely to QE3 and all the support we're seeing from central bankers. Is this making deal flow difficult with buyers feeling a bit nervous about paying those prices?
I think that's fair to say, Erica. I think if we look at the factors that contribute to a strong M&A market and strong deal flow, then certainly sentiment is one, but I think also the perception that there's good visibility on where the market is going and where earnings are going to come from is critically important to people's perception of what value they should be paying in transactions. And I think at the moment there's a mismatch between the perception of certainty that's out there and the valuations that are needing to be paid. So in that certainly lies a mismatch of where buyers are seeing value and where sellers are seeing value.
So let's talk about that, the perceptions of certainty. So feelings of uncertainty, unease really, not the confidence to take the money and pay those prices. So what exactly is it that the buyers need? You talk about the certainty about earnings. So there isn't much earnings visibility. We don't know if there is indeed a recovery ahead.
Absolutely. I think there is, globally and also in South Africa, I think there's grave uncertainty about the state of not only our economy but also the global economy, and the sort of patch job that was done post the 2008 crisis. I think people are certainly still far from convinced that we've solved all the structural problems that do exist in parts of the global economy. So certainly there's been the stimulus that's kept the global economy on the mend and kept it afloat for the last 5-6 years, but certainly the cracks are reappearing and far from the structural problems are far from solved. So against that background, I think people are questioning whether the valuations that seem to price in almost a perfect scenario of earnings predictability, whether that's really justified. So I think from that point of view, there's not the confidence that you need, and that's typically associated with strong M&A or deal markets. I think if we think about other components of stability and predictability, certainly political stability and specifically policy stability, I think is something that's maybe a more unique problem in the South African market, and particularly if we think about the more regulated markets such as resources perhaps. I think that's a real element of uncertainty in that market, causing investors to remain on the sidelines for now.
I'd like to go back to that, but just going back to the general theme of the uncertainty, are there any overriding factors that could still see M&A activity, corporate action going ahead? I think of, for instance, BEE, which in previous years has been a significant driver of M&A.
Yeah.
Is there a tailing off of that, or have most of the deals been done? So we're not seeing that as a source.
So I think, and our thinking about BEE generally is that it's not anything that's ever going to be done. I think we'll see waves of BEE coming, and we've seen probably 2-3 waves. And while it's true that at the moment we're probably midlife for many of the larger transactions, so many of them have been done, there's a phase, a lifetime of a deal, let's call it 7 to 10 years, and then new transactions will probably follow. So yes, it's probably a relatively quiet time for typical sort of primary BEE deals. But having said that, I think we think the BEE market is at a really quite exciting place, and I think we're at a place where we're seeing the formation and the creation of really sophisticated BEE investment holding companies that have emerged over the last number of years, and probably will provide the platforms for captains of industries going forward. So we think BEE is past an inflection point where it will have momentum of its own and not only be reliant on the facilitated BEE deals that we've always seen in the past. So we think BEE is in a relatively good space, quieter at the moment, but we think a new phase is sort of kicking off.
Could that also be true of private equity, because the drivers might be slightly different from general corporate action? Given how the cycle works, the fundraising cycle, many of the players are now in a fundraising process. So almost regardless of what the market circumstances are, they need to do those deals.
Absolutely. And you're right, there's similarities, there are obviously also differences, but I think in the private equity space we're seeing a great amount of capital that's available to be deployed, and it's the business of those funds to deploy that capital. I think that's probably the area of the market where people have most difficulty coming to grips with the valuations that are out there and needing to be paid. So if you think about the more defensive type businesses that typically lend themselves well to private equity transactions, those are the exact businesses that are quite expensive at this point in time. So some of the type of sectors that are arguably less suited, the more cyclical type of businesses, I think probably at the moment hold greater opportunity, but they're less suited to private equity. So the type of private equity investors that might see more deal flow will be the more flexible ones that have more flexibility in mandate in respect of sector, and also the type of influence that they need in the investee company.
Carel, just speaking to you before this program, you made it was a really good observation that you made, is you're not seeing those bold deals, those big deals that we've seen in the heady days of financial markets, more defensive deals. What did you mean by that?
So and we think there are sort of two discrete camps. They're the sort of bold deals that you see on the lamppost when you drive to work in the morning, that everyone's always excited about. But those are the deals that you need a lot of confidence for. You need momentum in the market, typically bull market sort of deals. So there are deals that rely on confidence and a great amount of conviction. Now we've got very low confidence because of the uncertainty of where markets will go. As a consequence, people are loath to spend money and do those bold deals. So when we then look at the sort of opposite, the more defensive type deals, back foot sort of deals, those are more about right-sizing the business, right-sizing the capital structure, optimizing the portfolio, typically divestments. So we're definitely seeing still more of that. So there's more there's more introspection about the portfolios and making sure that the company is happy with what its balance sheet looks like, what the portfolio looks like, and doing deals that are pursuant to those sort of goals. So those are perhaps less exciting and less sort of they're sometimes smaller. They're certainly less lucrative, if that's if that's important.
For corporate financiers.
Yes.
So going back to those bold deals, because typically, often those bold deals are delistings from the listed market, and it seems as though it's almost become politically incorrect to consider delistings because of the regulatory rigmarole, and it seems as though the authorities don't like such deals.
Yes, I think we've got a, let's start off by saying that delistings are a very natural part of the capital cycle and I think are very important. So as a financial market, I think it's important that we have a structure that allow for those sort of transactions to happen. That being said, I think we still have a legacy of limited investment opportunities, so the market is typically quite, it feels like it's deprived of an investment opportunity if a company is delisted, and hence you typically need to be enticed with a relatively attractive premium. But that said, so while I think investors are on balance, typically they need to be persuaded of delistings, certainly that's true, but I do think we've got a financial market structure that's got a very predictable sort of way of dealing with those types of transactions. But you're right to say that we've seen fewer of them just because of where valuations have been, and the same factors we spoke about before, lack of visibility on earnings to justify the multiples, and never mind the multiples that are out there, but also the valuations after you've applied a premium to it to get it off market.
Carel, how big is, or how long, deep is the pipeline that you're working on at the moment of deals, just as an indication of activity?
So my general sense is that the pipeline certainly, on our side, but I think I speak for the broader market, that there's a lot of activity going on. I think my feeling is that there's more activity now than there probably was 12 months ago. But having said that, I'm not sure that the conversion rate is any better than it was last year. So I think there's a lot of chasing of deals going on and working on sometimes speculative, sometimes more tangible opportunities. But we're seeing few of those ultimately being announced and being converted into successful deals. So the statistics of successful deals probably don't do justice to the amount of activity that's going on in the underlying market. But
so you guys are busier than we think.
Yeah, that's probably fair. But it's also a difficult market if you're busy, but the deals don't ultimately convert. It's not it's not a great market.
Carel, thank you very much. That was Carel Vosloo. He's co-head of the corporate finance division at Rand Merchant Bank. And that's a wrap for this edition of Deal Flow. Until next week, from me, Erica van der Merwe, it's goodbye.